When you begin learning about investing, a common question you may ask yourself is, why should you invest at all? Wouldn't it be better to store your safe money in a bank account or in a piggy bank at home? Well, to figure this out, let's first take a look at the goal of investing and then the reasons why you might want to invest. The goal of investing is to accelerate the growth of your wealth by acquiring assets that yield greater returns in the future. So, you want to buy something that helps you make more money over time. There are two primary reasons for doing so. The first is to combat inflation, and the second is to increase your wealth. Let's take a closer look at the first reason, inflation. Inflation occurs when the prices of goods and services increase gradually over time. Examining the inflation rate in the US over a span of 20 years from 2000 to 2020, the average annual inflation rate was approximately 2.06% during that period. So, on average, prices went up by 2.06% year on year. So, why is that? One factor is a higher demand for goods compared to the available supply. This situation can arise from factors like increased consumer spending when people have more disposable income, the government injecting more money into the economy, or low interest rates leading to easier borrowing and prompting people to want to make purchases now and repay gradually over time. The other factor is the rise in production costs for goods and services. This increase can stem from various sources like higher wages, elevated raw material expenses, or disruptions in the supply chain. Let's look at an example. In the year 2000, John is spending around $1,000 a month for goods and services such as groceries, electricity, water, TV, phone, and so on. So $12,000 a year. After a year with 2.06% of inflation rounded to full dollars, John will have to pay $1,021 a month, which equals to $12,247 annually. Extrapolating this to 20 years, John now has to pay a whopping $1,497 monthly, which equals to $17,964 annually. So after 20 years, John pays now $497 more per month, which equals to $5,964 more per year for the same goods and services rendered as 20 years ago. See how inflation is very slowly but surely eating away our buying power and wealth? This is where investing comes in to either stay on par with inflation or even beat inflation. Let's assume for a moment that John isn't used to take much financial risk. He therefore decides to put $12,000 in a time deposit account at the bank, which yields a guaranteed annual return of 2.06%. So after 1 year, John will receive $247, which helps him exactly to stay on par with inflation and continue consuming the same goods and services without losing any buying power. He then reinvests the $12,000 for the next year to receive the same amount again. If John is lucky, the bank might even offer a time deposit account with 3%, or he is able to invest more than $12,000. In both cases, John would have beat inflation and would have had a little more money left at his disposal. But John could have also invested the $12,000 in a more risky investment, such as, for example, a mutual fund or ETF that, after deducting the cost of the fund, returns 6% per annum on average. So instead of receiving $247 at the end of the year, he is now receiving $720. So he has now $473 more at his disposal, which he could, for example, use to buy higher quality groceries or reinvest the money with the $12,000 to receive even more money the next year. He increased his wealth over inflation, which brings us to the second reason to invest, increasing your wealth faster. Why would you want to increase your wealth faster? There could be several reasons, such as retiring early, investing into one's children's future education, or buying that Lambo, mega yacht, or mansion in LA. It's important to understand that each investment carries its own level of risk. For instance, a time deposit or high-yield savings account is considered very safe, as the bank typically guarantees the return, albeit with lower yields compared to investing in company stocks. Investing in company stocks, on the other hand, carries more risk but generally offers higher returns, which are not guaranteed and can vary. The key concept here is that the higher the risk of an investment, the greater the expected returns must be. Perhaps you are familiar with the saying, no risk, no reward. And that's it. These are the benefits of investing in a nutshell. Keeping on par with inflation or growing your wealth faster. If this video was valuable to you, I'd appreciate if you can click the like button and consider subscribing if you want to follow the series. Have a good one and see you in the next video.